Hi everyone, my name's David and today I'm going to be discussing the difference between net profit and gross profit. What's the difference? Okay, so we'll start off with gross profit, and the easiest way to just tell you how to work out gross profit is to start off with working out the gross profit for just those line items, so just one product. And as an example here, I've used a sale price of a bottle of wine at £20. Notice please that is the ex-VAT bottle of wine price. So if it was if you get the gross price from the till, for instance, it would be £24. If you get your calculator, divide 24 by 1.2, that will give you the net price without VAT. You then go to your supplier invoices, which should always quote the ex-VAT price anyway, and you find out the cost of that bottle of wine is £8. To get the gross profit, you would take the sales price less the cost of sales price, so 20 minus 8, and it will give you a gross profit of £12, 20 minus 8. To equate this to a GP percentage, you would then divide that gross profit of £12 by the original selling price of £20, and if you put that in your calculator, you will come up with 0.6. If you divide that by 100, it will give you 60, and that is your GP percentage. Coincidentally, if you use a spreadsheet to do this, you could just put in the formula of 12 divided by 20 and then format the cell as a percentage, and it will automatically times it by 100 for you. Okay, and that's how you get a 60% GP on a bottle of wine. These are obviously made up figures. I'm not saying that's what you would sell your wine for or buy it for. So that's gross profit per line item, which is good when you are costing a product to see how much you want to sell it for, or if the stock taker tells you that that product's not very good, not making a very good margin on that, then you could work out a new price for it, and it's good for that. But it doesn't give you the gross profit for your business for a particular, say, a month. So the gross profit formula for, let's say, a period of 1 month would be your sales for that month minus the cost of sales for that month, and I've put that in bold because we're going to discuss that in a bit more detail in the next slide, and that would give you the gross profit for the month. Now, what this cost of sales figure has to do is match what you sold, and I'll explain that in a second. To give you the gross profit percentage for that month, it would be the gross profit divided by your net sales, that's without VAT, for the month, and that will give you the gross profit percentage for the month, or GP percentage as it's abbreviated to. Please note, sales must be excluding VAT to keep consistent. So cost of sales, often abbreviated of COGS, which is cost of goods sold. It's the same thing. When you're working the cost of sales for a particular month, you need to first start off with what you already had in stock. You then add the purchases to that figure, and you take away the value of the stock you're left with at the end of the month. Now, imagine if your opening stock beginning of the month and the closing stock at the end of the month were exactly the same, then the cost of sales would just be the purchases, right? Because these two, opening stock and closing stock, would just contra each other out. The reason you have to put opening stock and closing stock valuations in is because very rarely or hardly ever at all will they be the same. So I get a lot of clients saying to me, well, we don't do stock takes, or we do, but we do them ourselves, or we only do them every year, and that kind of thing. What can we do, apart from this formula? Is there another way of doing this? Well, there's a rough way of doing it. So if you want an accurate way, you have to use opening stock and closing stock. Some accountants will actually record this as opening stock minus closing stock, and they'll call it stock movement, and they'll have one figure stock movement in there plus the purchases, right? But that's the actual formula: opening stock plus purchases minus closing stock. If you don't want to have a value of the stock, or you just don't do it, or your stock taker only comes every 3 months, and you want to know what your cost of sales figure is and what your GP therefore is, the only way to do it is to take it over a longer period of time. And the reason I'm saying that, imagine in the month, if the difference between your opening stock and the closing stock was £200 and your sales for that month were £20,000, then the £200 makes a very small difference, but it's still a 1% difference. If you then put your purchases over a longer period of time, then the difference between the opening stock and the closing stock will make less of a difference. So £200 over a 6 months period, it wouldn't really matter if you're only £200 out when you're measuring over 6 months. But if you're doing a weekly cost of goods sold, or even a monthly, you really do need some stock adjustments either side. So, as I said before, the gross profit formula is the net sales less the cost of sales equals the gross profit. So what is net profit? That was the gross profit. So the net profit, that comes after the gross profit. So you have your gross profit, and then you take away the costs of the business. And if you want to do a percentage, it'd be net profit divided by net sales times 100, or on the spreadsheet, formulate the cell as a percentage. So gross profit minus overheads equals net profit. And that's the difference between net profit and gross profit. However, is net profit really what you're looking for? So to answer that question, I have to first explain the difference between management accounts, which are for you, the client, or financial year-end accounts or tax accounts, which are basically for Companies House and for HMRC, or just HMRC if you're a sole trader. The financial accounts have to follow a set parameter of standards, accounting standards, UK GAAP, and there's also international standards if you are within those thresholds. So the accountant has to follow a set of standards, and that's how the net profit is calculated. Net profit can be net profit before tax, and it's also shown as net profit after tax. So you're only really looking at net profit really once a year. Management accounts are for you. And what you want to call that bottom line, it really doesn't matter. I mean, I've just called it bottom line there, for instance, and quite a lot of my clients call it the bottom line. What is the bottom line? It's what you want to see. So it's the management accounts for you to make operational decisions based on those accounts that you're receiving. You're not getting management accounts to show you what your tax liability is every month. You're getting management accounts to help you make management decisions on the operations of your business. However, if you do want to know what the difference is between these different ones I've got here, the net profit takes all of the income and the costs, including depreciation, interest and everything, into account and is shown before and after tax. Operating profit excludes anything that is non-operational costs or operational income. Interest, any other income that you don't normally show, a sale of assets, fixed assets, that sort of thing. EBITDA stands for earnings before interest, tax, depreciation, and amortization. So if you've ever heard that mentioned before, EBITDA, the banks quite often refer to this. It's earnings before interest, tax, depreciation and amortization. Amortization is just a different version of depreciation. Now, this figure is a very good one, operational P&L. You don't need to call it EBITDA if you don't want to. Call it net profit if you want. Call it profit. Call it bottom line. But it's quite a good one because it takes your operational profit, takes out all the stuff you can't control. The interest on your loan, you can't control that. The tax you're going to pay doesn't matter on a monthly basis. And the depreciation and amortization are costs that are long ago spent. Nothing you can do about that anymore. So, in a nutshell, I always go through my clients, I call it operating profit, and I take away depreciation as well, and I take away the interest and of course the tax. So really I'm giving them EBITDA, and I call it operating profit. But like I said, doesn't really matter what you call it, it's between you and your accountant, and just make sure that it's consistent, of course, and that every month or quarterly, if you're doing management accounts quarterly, you stick to the same profit method throughout the year. Okay, I hope that's been useful. If you have any queries on this, please feel free to give me an email at hello@carrollaccountants.co.uk, or check out our website for other videos, www.carrollaccountants.co.uk. Carroll, notice 2 R's and 2 L's. Thank you very much.